Welcome to another episode of A Quest for Twice. Today is December 20th, and this is the last episode for this year. So today, I'm going to make a prediction for the stock market in the 2023. To me, the key question is what will happen to the S&P 500 earnings next year. So let's look at this graph on the right. So you can see the consensus forecast for this year and next year as a function of the time. And both estimates peaked in the summer, then declined. And the earning forecast for next year declined much faster. Then the question is how that will change in next year. So I believe S&P 500 for this year, the earning will be about $220. Then there will be two scenarios in next year with different impact on next year's earning. The first scenario is stagflation. The inflation looks like has peaked, but it may stay stubbornly high and declines slowly. As a result, the unemployment rate will still be low, under 4%, and the Fed holds a rate above 5% through the year. In that case, my guess for the S&P 500 earning next year will be about the same as this year. The second scenario is a recession. So the inflation drops towards 3%, and the unemployment rate rises from the current low level below 4%. Then before year end, the Fed will hint at rate cuts. For that scenario, next year's earning will be less than this year and less than $220. Now I'm going to go over the performance prediction for my portfolio, and the stock prices listed were at the closing on December 19th. Currently, 4% of my portfolio is in cash. Under the stagflation scenario, I forecast the cash will outperform the market by 10%, and in the recession scenario, cash will outperform by 5%. However, my conviction is low because it's really difficult to forecast the stock market general performance. The reason I think the stock market will decline more in the stagflation scenario than the recession scenario is because market is forward-looking. So under the stagflation scenario, the earnings will hold up, but the interest rate will stay high. The market will think a recession is delayed but not avoided. Therefore, the market will decline more than the recession scenario, where the market will look past the recession at the recovery and the beginning of the next economic cycle. For Aqua, at $113 per share, it's about 35% of my portfolio. Its valuation is very attractive. EV over EBITDA is 8.2, and forward PE is about 9, with a narrow moat for the company. Because of the low valuation level and the growth tailwind, I think the stock will outperform the market in both the stagflation and recession scenarios, and I have a high conviction in that. For energy transfer, it's over 20% of my portfolio. Its forward dividend yield is over 10%, and more importantly, its discounted cash flow yield is about 22%. That means the company will have plenty of cash left after paying dividend and the current capital expenditure level. So the actual cash can be used to buy back shares or even increase dividend or buying smaller rivals. That's why I think the company stock will outperform the market regardless of the scenarios, and I have a high conviction. It's a different story for Kinder Morgan. Its dividend yield is 6.3%, and the DCF yield is 12%. We can see and compare with the energy transfer, the yields are much lower for Kinder Morgan. For this reason, I think it will outperform the market in stagflation scenario, but underperform in a recession scenario when the demand is hit by the recession. I also have a high conviction. Ingredient, its PE is about 15, and forward PE is 12.5 with a narrow moat. So I think it will outperform during stagflation, but have a market performance during recession. That's because it makes food ingredients, and that's recession resilient because people still have to eat during a recession. For Emerson, its valuation level is fairly attractive at the EV over EBITDA of 12. According to Morningstar, it's 11% undervalued, but it has a wide moat, so it can raise price during an inflationary environment. That's why I think it will outperform during stagflation and have a market performance during recession because it will benefit from a long cycle capital investment. So its demand probably will be less affected by the recession. I have a high conviction. So Walker Dunlop has a fairly attractive valuation levels. PE is 11, and the EV over EBITDA is less than 10. I'm not sure if it has any moat, but I think it has very attractive valuation levels. Given that the interest rate will either stay stable during stagflation or interest rate will decline during recession, I think the stock will outperform during either scenario because Walker Dunlop's business will be helped by stable or declining interest rate with its current low valuation levels. I think it will outperform the market regardless. But I only have a medium level conviction. For Fidelity Information Services, its valuation level is attractive. According to Morningstar, it has a narrow moat. So I think it will outperform during stagflation environment and have a market performance during recession. But I have a low conviction because I haven't spent enough time to understand its business. Now I'm shifting gear to look at the stocks in my growth portfolio. The top 3 in my growth portfolios are Equifax. Its EV over EBITDA is 18 and 36% undervalued according to Morningstar. Has a wide moat. I have a medium conviction in that its stock will underperform during stagflation with a high interest rate, but outperform during the recession with a declining interest rate. It's a similar story for Mercado Libre, about 24% undervalued according to Morningstar, has a wide moat. Although mode is a part of the growth portfolio, but it's valued as if it's a value stock because its PE is about 18 and the forward PE is 15 with a CAGR of 45%. I believe it has a narrow moat because of its fast pace of growth and low valuation level. I think the stock will outperform during either scenario, and I have a medium conviction. But overall, I think my growth portfolio will underperform during stagflation and outperform during recession. The main reason is the interest rate. For higher interest rate, that means higher inflation. So the market will stay away from growth companies and invest in value companies. However, during a recession, the growth companies actually are stronger financially, so they will outperform the value stocks and the overall market as well during a recession. Now, let me review my growth portfolio in details. In the pie chart on the right, it shows the weight of each stock as a percentage of my growth portfolio. So Equifax and Mercado Libre are the two top holdings in my growth portfolio, followed by Emote. Amazon and Metaverse are also fairly significant holdings, then followed by JFrog and Salesforce and Microsoft. In this table, I listed the price for each stock that has a higher weight in my portfolio, and its price over sales comparing to its average price over sales in the last several years, and its valuation discount, as well as moat evaluation and my conviction in that stock. I converted the conviction to a multiplier and used the multiplier times valuation discount to get my portfolio score. So the higher the portfolio score is, the more it should carry in my portfolio. For example, Equifax has a score of 37%, and JFrog has a score of 10%. Therefore, the value of my Equifax investment should be about 3.7 times of the value of my investment in JFrog. One thing I want to point out that the price over sales as a valuation metric cannot be used to compare to other stocks in my portfolio, because they have all very different businesses, and price over sales is more useful to compare with its historical average. For example, the Equifax price over sales is close to its historical average, and the Mercado Libre is much lower than its historical average, and it's even more extreme for Upstart. Its current price over sales is only slightly more than 10% of its historical average. What's also interesting is that if we look at all these stocks and their current valuation compared to their historical average, then we can see that their current valuation, each one is lower than its historical average. Obviously, its current valuation level for an individual stock has its idiosyncratic reasons behind it. For example, Meta has a 2.7 PS ratio compared to 8.7 historical average, and that's because of the revenue decline. So that's a really bad sign for a growth company. However, if all of them have a lower valuation level than average, that tells me that the market becomes too pessimistic about the growth companies. Therefore, it's a reflection of market inefficiency and irrational valuation of the growth companies. That presents investment opportunities for a patient investor like myself. After I compare the portfolio score for each stock in my portfolio with its current weight in my portfolio, I realized that I need to add more in Equifax, Upstart, Metaverse, Amazon, and Google. So that's a great segue to the discussion of my action plan for next year. So for next year, I plan to continue to hold my Accor and energy transfer stock, despite the combined they are a very significant portion of my portfolio and presents a concentration risk. But I believe the risk is outweighed by their attractive valuation levels. I plan to rebalance my growth portfolio based on their portfolio scores, as I discussed on the last slide. I also plan to add ingredient during pullbacks because I believe it will outperform during a stagflation and market performance during recession and be recession resilient. As I pointed out earlier, I think Walker Dunlop will outperform regardless of stagflation or recession. So I plan to refresh my investment thesis and increase my conviction, and then buy more Walker Dunlop during pullbacks. I also plan to deep dive into Fidelity Information Services to increase my conviction and may lead to increase my investment in that company if I have a higher conviction. This concludes the last episode of Quest for Twice for this year. I wish everyone a successful and happy 2023. Until next year, happy investing.